Points here. I think one of the, we'll just jump right in. A lot of folks say flat out, private equity is the wrong cost of capital for minerals. If ideally you want a pension, you want a family office, you want an insurance company who has extremely low cost of capital, can hold the asset into perpetuity. And because private equity traditionally needs an exit, it's just, you're on a shot clock, and that puts pressure on timing. Things like COVID and the oil price war push development timing out. It really can screw up with the economics of your portfolio. And now year 4, 5, 6, 7, when you really need to exit for the fund, it doesn't make sense for the asset class. And so a lot of folks say it's just the wrong cost of capital. Now, I believe there's a role that kind of capital and publics can't buy undeveloped. And if all you're doing is buying producing minerals, that's a shrinking universe. So there is a role, at least in the last 5 to 6 years, a role for private equity to come in and take that development timing risk and let the assets mature to then exit, right? But I'll let you guys kind of defend yourselves, because there's plenty of success cases out there, right? It's not like all dollars in private equity that went out are just stuck and dead. There's plenty of people on this panel who have had companies exit and have made good money. So real quick, around the horn, kind of, when you hear that, what is your initial response or defense that PE is the wrong cost of capital? Who's feeling lucky? We'll start with Jason or Kyle. Kyle's
Tim, I think you hit on it, right? I think that it's easy to say that it's gosh, it ought to be a super low cost of capital. It's a yield-oriented strategy and so on and so forth. But it kind of depends on, which part of the game you're playing. And certainly to the extent you're taking development risk and timing risk and drill bit risk and economic risk, you start stacking all those risks on top of each other, and it becomes something that's not generating cash flow right away. And that, given all those risks, we believe can generate a higher return, and hopefully the rest of the market is pricing the asset as such and bidding it to a higher return. I think you could certainly argue that there's been, times in the market, times in oil and gas in general, where there's a lot of capital chasing opportunity, and therefore the market bid down opportunities to rate of return that maybe was more aggressive. But I think generally speaking, if you're taking development risk, you're taking geologic risk, the development timing is out of your control. There is no cash flow there. Those are the types of things that typically the capital required is going to demand a little bit higher return. And therefore, I think there is a role for private equity to play. As you mentioned, those are hard deals for the public mineral players to do, because they do have a large investor base that's very yield oriented. So for them to go do a super dilutive acquisition to their cash flow is difficult. And then I think kind of those lower cost of capital pension type investors that you're talking about also are hesitant to go put a bunch of capital out there that's not going to generate yield. So I think there's definitely a role to play. Markets are always changing, and you've got to adapt your underwriting to reflect kind of the current environment. But I definitely think there's a role for private equity to play.
I think that last comment is important. I think what we're good at as an industry is adapting, and our job is to go find where there's arbitrage opportunities and kind of inefficient pockets of the market. And that was a big part of the earlier days of our capital deployment into this space. And, a lot of the quick flip, easy arbitrage opportunities they're a lot tougher to come by, certainly now. Even a year ago they were, but the strategies will adapt over time. And I may take a little I'll push back on the short-sighted nature of our model generally a little bit. I mean, I'm pretty sure all of us are investing with 10+ year funds. So there's not an immediate need to punch out within 2 years, no matter what. We've got the ability to hold it. And I'd say most of these assets that we've bought and continue to hold, the ones that we haven't sold for good outcomes, their intrinsic growth profile still exceeds our hurdle for what we're really trying to achieve. So as long as that's the case, I think we're pretty comfortable being patient and not trying to force liquidity when it doesn't make sense.